Welcome to today's webinar, hosted by PYA, Taxation and Reasonableness of Alternative Forms of Physician Compensation. Before we get started with the webinar, I'd like to go over a few housekeeping items. As this event is for CPE credit, there are some additional steps that we will take in order to comply with NASPA requests. In accordance with NASPA, attendees will be provided 3 polling questions throughout today's webinar. Responses are documented electronically. Attendees must respond to these polling questions within the allotted time in order to receive CPE credit for this course. A post-event survey will also be provided for attendees to submit regarding their webinar experience. The polling questions and the post-event survey must be submitted for proof of participation today. You will have the opportunity to submit questions to today's presenter by typing a message into the question pane of the control panel. We'll collect these and address them during the Q&A session at the end of today's event if we have time. If not, our presenter will reach out to you directly. Now I'd like to welcome Amy Barnhill with us today from FHA to kick things off. Welcome, Amy.
Thank you, and good morning, everyone. My name is Amy Barnhill, and I'm the meetings manager here at FHA. We are delighted to have the opportunity to partner with PYA in an effort to support our member hospitals. PYA is an inaugural financial underwriter of the FHA Research and Education Foundation and a leading professional services firm providing expertise in healthcare, tax, management consulting, and audit and assurance. With that, I would like to introduce Emily Smithson, tax manager at PYA.
Thank you. Good morning, and thank you for allowing me the opportunity to speak to you today. I am Emily Smithson. I'm a tax manager with PYA. I predominantly work with hospitals and health systems that are tax exempt and advise and assist those hospitals and health systems with obtaining and maintaining their tax exempt status. Today, we are going to talk about physician remuneration above and beyond regular wages. In today's world, the compensation packages provided between hospitals and physicians can be creative and offer different types of remuneration other than your simple base wages that we used to have. Specifically, contracts today tend to offer additional items over and above wages, such as bonuses, possibly forgivable loans. There may be some student loan repayments, tuition or housing allowances, or other items. We're going to discuss these items and the tax liability that may or may not result from each of those items. In addition, we're going to talk about the difference between an independent contractor and an employee and how that can affect the tax liability. As we go through this discussion of each of these types of additional remuneration, we also need to consider how they affect total remuneration and compensation paid to the physician as measured by regulatory agencies and IRS reasonableness of compensation. Let's start at the beginning. We are a hospital and we need to hire a new cardiologist. So the first thing that we're going to do is we're going to go out and recruit a cardiologist. We find one, we want to have them sign on with us, and so oftentimes the hospital is going to offer the physician a sign-on bonus. A sign-on bonus is a single payment paid up front. It may or may not be before the physician actually begins service to the hospital, but it is a payment contingent upon the physician providing service to the hospital. Therefore, the sign-on bonus is going to be taxable to the employee in full when paid. This differs from a forgivable loan that may be offered at the same time. It may be offered to encourage a physician to sign on for service with our hospital. However, The forgivable loan has a component to it whereby a portion or all of the loan can be forgiven based on service that the physician provides to the hospital. In order to be a bona fide loan, there must be a stated interest rate, and generally there must be other documentation, such as a promissory note or clause in the contract that designates this payment as a loan to be either repaid in cash or forgiven over the life of the loan based on service that the physician provides to the employer. Of course, this is an arrangement that is beneficial to the hospital because the hospital wants the physician to stay employed and continue to provide service to the hospital. Let's look at an example. Let's say that the hospital recruited the cardiologist and agreed to pay the cardiologist $50,000 upfront if the cardiologist will stay and provide service for 5 years. The loan can be forgiven ratably over the 5 years if the cardiologist stays in employment with the hospital. So in simple math, we would take the $50,000 loan, divide it over the 5 years, and there would be $10,000 forgiven each year. That portion that is forgiven each year, $10,000, is included in the employee's income and W-2 subject to taxation like regular wages for each of those 5 years. When the actual cash is provided to the physician, usually upfront, maybe even before the physician begins employment, that is a loan and is not a taxable event. In other words, the physician will not pay tax on the $50,000 when the cash is received. The physician will pay tax on the ratable portion that is forgiven over each of those 5 years, again, $10,000 per year. A retention bonus, of course, is similar to a sign-on bonus in that it's paid all at once. And at the time that it's paid, it is subject to tax and included in the employee's W-2 wages. A sign-on bonus is generally paid prior to employment or at the very beginning of employment. A retention bonus is generally paid at some time later after the employee has begun and continued employment and is a bonus paid to encourage the employee to continue service to the hospital. To recap, both the sign-on and the retention bonus are taxable when paid. The forgivable loan is taxable when the service is performed. Now, we've recruited our physician. He has agreed to come provide service to the hospital, but the physician lives in Missouri and our hospital is located in Florida. So, of course, our physician is going to want the hospital to reimburse or pay for the moving expenses to relocate from Missouri to Florida. Prior to 2018, qualified moving expenses could be paid or reimbursed by the employer and not included in the employee's income. However, the Tax Cuts and Jobs Act of 2017 changed that rule. For tax years beginning in 2018 and going through 2025, moving expenses are no longer excludable from the employee's income, with the exception of certain military taxpayers. We're assuming in our situation, of course, that our cardiologist is not a military taxpayer because that provision of the law is designed to benefit active duty service members who need to move as part of their service. Therefore, their moving expenses can be excluded from their income. However, all other taxpayers, to the extent that the employer pays for or reimburses the moving expenses, it's going to be included in the employee's income. So in our case, our cardiologist may have the moving expenses paid for by the hospital, but all of the value of the moving expenses will be included in his W-2 wages. This is the same whether the hospital pays the cardiologist directly to reimburse for expenses or whether the hospital pays the moving company directly. It does not matter who the payment is specifically remitted to. It is still a taxable benefit to that employee. This is a double-edged sword, meaning it's good and it's bad. It's It increases the tax liability of the individual employee, but it greatly reduces the complication and the paperwork need on the employer's behalf, because prior to 2018, the employee was required to substantiate expenses. The most frequent way to do that was to provide receipts. After 2018, there is no IRS requirement for substantiation because all of it's included in income, whether there are qualified receipts or not. The hospital may still want to request receipts for its own record keeping, and that's fine, of course, but there's no IRS requirement for it. Prior to 2018, a hospital paying moving expenses was part of the sweetening of the deal to get the physician to sign on, because those moving expenses were excludable from income. And so potentially a portion of an otherwise taxable sign-on bonus could be carved out and reimbursed as moving expenses that would not be subject to tax. However, of course, beginning in 2018, that is not the case. The moving expenses are taxable and thus need to be at least considered when looking at overall compensation and remuneration paid to the physician when considering fair market value and reasonableness under the Stark Law, other regulatory agencies, and of course the IRS concept of reasonable compensation. Now it's time for our first polling question.
Thank you. The first polling question is, does your organization offer forgivable sign-on loans to employees? Yes, no, or I don't know. Please remember, you must fill out the polling question in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Emily.
Thank you. We have now employed our physician. Our physician is on staff, and as is commonly the case, the physician would like for the hospital to pay certain expenses on behalf of the physician. The general rule is, if the expenses would be deductible by the physician himself on his own return, if he paid the expenses directly, then the business or the employer can pay those expenses directly and not include them in the taxable wages of the employee. In other words, are these expenses such that they allow the physician to be credentialed and operate as a physician in the state, under state law, etc., and provide service as a physician within the hospital, then they are qualified business expenses of the hospital and can be paid by the hospital and not included in the taxable wages of the physician. Listed here are some common examples of expenses paid by a hospital on behalf of a physician, but it's of course not a complete list. Continuing medical education, of course, there's a business purpose to keep the physicians credentialed and educated. Therefore, those can be paid. Malpractice insurance, dues and licenses, and scrubs and uniforms. To the extent that the hospital provides scrubs or uniforms for the physician and kept on site for laundry to be laundered, that can be excluded from the taxable wages of the physician. Another area where many hospitals, especially in Florida, have it is an on-site rest or sleep area. It is in the hospital's interest at certain times to keep the physicians and medical staff on site so that they can be available for an emergency or other need. Unfortunately, here in Florida, we have hurricanes. Sometimes the hospital will request that a physician or a nurse remain on site instead of going home until their next shift, because the medical provider may get stuck at home and may not be able to return back to the hospital. In those instances, there may be an area where the medical provider can rest, possibly even sleep, and the hospital may provide basic toiletry items. All of those are clearly for the convenience of the hospital and the patient's safety and are not going to be included in the wages of the physician or other medical practitioner. In addition, most hospitals have an on-site cafeteria for the benefit of the patient's families, friends, employees, and possibly even the patients themselves. To the extent that the hospital provides free meals to medical staff to keep the medical staff on the premises, again, in case there may be an emergency or other need, those meals are for the convenience of the employer and, of course, overall patient safety, and would not be included in the taxable income of the employee. In order for all of these to be paid by the hospital on behalf of the employee and not included in the taxable wages, the hospital must have an accountable plan. An accountable plan is simply a policy that says that these expenses must be substantiated by the employee, if not paid directly by the hospital. That's as simple as the employee is going to provide receipts. If the employee is going to pay for their own CME or possibly for their own medical dues, the employee would be required to provide a receipt for such payment to the hospital to substantiate the reimbursement. Alternatively, perhaps the physician receives the notice from the Department of Professional Business Regulations stating that his license is up for renewal. The employee may provide that letter to the person at the hospital responsible for writing checks, and the hospital would write the check or remit the payment directly on behalf of the physician. That is, of course, perfectly acceptable, and the letter itself is substantiation for the expense. Other types of benefits that may be provided are lodging and certain types of travel. Permanent lodging may be provided to an employee only under specific conditions. Permanent lodging would be lodging that is considered to be the employee's main home or house or domicile, and that the employee intends to live there for at least a year and going on into the future. This benefit can be provided to employees and not included in the employee's wages only if all three of the following conditions are met. The first is that the housing must be on the employer's premises. The second is that it must be for the convenience of the employer, not the employee. And the third is that it must be a condition of employment to be excluded from wages. A common example of this would be a prison warden. It is the prison's policy that the prison warden must live in the house on the premises, of course not within the fence line, but on the outside of the premises of the prison in order to be available at all times to assist in case of an emergency, and it's required as a condition of employment. In that case, all three tests are met, and the provision of housing for the warden is not taxable to the warden. We likely are not going to see this very often with a hospital, first and foremost because most hospitals don't have housing on the premises. However, if they do, and they need the physician to stay in that housing as a condition of employment, then that could be excluded from the physician's wages. We also see the situation where visiting nurses or other medical providers need temporary housing because they are providing service to the hospital on a temporary basis. Temporary is defined as 1 year or less. In this situation, the nurse or other medical provider should have a tax home, meaning their main home where they live all the time, outside of the service area of the hospital. They're brought in to provide temporary service, again, less than 1 year, to the hospital, and the distance is such that they cannot travel home each day. In this situation, the hospital may provide housing to the nurses or other medical providers that will not be includable in their wages. It is important to note that the provision of the housing allowance is not the same thing as a hospital requiring a physician to live within the same community or within a certain distance from the hospital. It is sometimes common, depending on the area where the hospital is located, that a hospital will require a physician to live within 15 miles or so from the hospital, such that the physician is able to return to the hospital quickly if a need arises. This is not the same thing as the housing allowance or, of course, the temporary housing, because this is simply a requirement of where the physician is going to maintain his or her own home. In addition, oftentimes, physicians need to travel, most often for continuing medical education purposes, and this travel is away from home and takes place over more than one day, requiring an overnight stay. If the main purpose of the trip is business purpose, then the trip is not included in the wages of the employee. Simply because there is a portion of the trip for which there is personal enjoyment does not negate the entire trip from having a business purpose. Continuing medical education has a clear business purpose for the hospitals. One, because it's required for credentialing and licensure for the physician, and two, the physician gains more knowledge and expertise in his or her area, which benefits patients, therefore being in alignment with the exact purpose of the hospital. Therefore, sending a physician even to what might be considered a fun location, for instance, Las Vegas, for continuing medical education, is still going to have a business purpose if the physician is attending the medical education program for what would be considered a normal work day, most likely 8 hours. Just because the physician then goes to the pool in the evening afterwards and has some personal enjoyment from sitting by the pool does not negate the fact that the overall trip is for a business purpose, and therefore the expenses can be reimbursed to the employee without being included in the taxable wages. However, if the employee participates in certain events that are purely of a personal enjoyment, for instance, he purchases show tickets to a Las Vegas show. If the hospital chooses to reimburse for that, that is personal enjoyment and not a business purpose, and therefore should be included in the taxable wages of the employee. Next, we can talk about tuition and student loans. There is a provision in the Internal Revenue Code that an employer may reimburse an employee for qualified tuition expenses up to the annual limit, which is currently $5,250. However, this only applies for tuition that will help grow an employee's skills or improve their ability in their given area. If the tuition is paid for coursework that qualifies the employee to perform for the minimum standards for their current job, then the tuition may not be reimbursed and be excluded from income. It may be reimbursed, but it would be included in income. We don't see this very often in a hospital setting because medical professionals have to be fully licensed and credentialed before they can begin service. But you may see a situation where you have maybe an accounting clerk that began service many years ago when he or she was 18, and at the time there was no education requirement. But now, 25 years later, to perform that same duty, the hospital requires the candidate to have an associate's degree in accounting. This employee chooses to go back to school to get the coursework to obtain an associate's degree in accounting to maintain his or her current job. In that case, that is tuition paid to meet the minimum educational requirements of his or her current position and therefore cannot be excluded from the wages of the employee. Now, in order for a hospital to provide tuition assistance, it must have a formal educational assistance program, and that program cannot discriminate in favor of highly compensated employees. Depending on the exact salary nature of each individual hospital, this could potentially mean that the hospital cannot have an educational assistance program that only provides tuition assistance or tuition reimbursement to physicians, because oftentimes the physicians are the highly compensated employees. That should be examined on a case-by-case basis, however. Alternatively, to the extent that the employer pays student loan payments on behalf of an employee, that is always going to be taxable to the employee. Someone might say, well, tuition can be excluded, but not the student loan repayment. And unfortunately, yes, that is the answer currently. Whether the hospital pays the student loan repayment directly to the physician or other employee, or makes the payment directly to the student loan provider, does not change the answer that student loan repayments are always taxable to the employee. We do occasionally see legislation pop up that intends to allow an amount up to the tuition limit, again this year $5,250, to be paid on an employee's student loans by the employer and have it not included in the wages of the employee. However, currently that is not the law. We don't expect that to pass in the very near future. So under current law, student loan repayment is taxable to the employee. And now we're on our second polling question.
Thank you. The second polling question is, if a hospital pays for continuing medical education and state licensure for employee physicians, is it taxable to the employee? Please select one, true or false. Remember, you must fill out the polling question in order to receive CPE credit. You will have 45 seconds to answer. Thank you for participating in our poll. Now I'll hand it back to Emily.
Thank you. On the first polling question, there was no right or wrong answer. However, on the second polling question, there was a correct answer, and that is false. A hospital under an accountable plan reimbursing CME for an employee is not taxable to the employee. The following discussion about parking is somewhat new and somewhat baffling to some people. The Tax Cuts and Jobs Act of 2017 changed the rules and indicates that the cost of employer-provided parking is no longer deductible for taxable entities and must be included as unrelated business income, or UBI, for tax-exempt entities. This is where I said this could be baffling. The cost of providing parking to employees could potentially be income to a tax-exempt entity and subject to tax. One thing to consider when considering parking is the makeup of the parking lots provided by the hospital. There is a safe harbor in the law that says that if more than 50% of the parking is available for the public, and that includes patients and visitors, then we can exclude the costs from that entire parking area from our calculation of the cost of employer-provided parking that must be added to unrelated business income. This only applies to the extent that we have unreserved parking, meaning we have a parking area where employees and the public can park, and the typical use of that area is at least 50% used by the general public. Again, that could be patients or visitors or vendors or any other member of the community. If we have reserved employee parking, and this means reserved not only for physicians but for any employees, then we must take into account the cost of providing that parking when considering unrelated business income. Fortunately, the IRS has issued guidance that indicates that the cost of employer-provided parking is only the ongoing operating costs of that facility or location. These are typically utilities, cleaning, maintenance, trash removal, snow and ice removal, security, etc. Ongoing costs to maintain and provide the parking area to the employee. It does not include the cost to build the structure or any related depreciation. This is good news because it means that if a hospital has a parking garage, the cost to build the parking garage, and again, the related depreciation, is not included in the cost of employer-provided parking for our calculation here. To the extent that the hospital has an exposure for the cost of employer-provided parking, this must be reported on Form 990T, which is the return for unrelated business income for a tax-exempt entity. And the hospital could be subject to tax. Employer-provided parking is not considered a separate trade or business, however, therefore it can be offset by certain NOLs when filing that return, NOLs being net operating losses. There are two situations whereby the employer can shift or reallocate the liability for the employer-provided parking and reduce or eliminate its exposure to UBI. The first is if the hospital reports the cost of the employer-provided parking in the W-2 wages of the employees. Therefore, that benefit is taxable to the employees. The second is if the tax-exempt hospital charges employees for use of the parking spaces. Neither of those is a particularly employee-friendly option, and so it is probably not going to be the go-to solution for the majority of hospitals, of course, depending on the location, the makeup, and the structure of the parking facilities at those hospitals. However, if the hospital were to take the option of either reporting the cost of the parking in the employee's W-2 or charge a fair market value for the use of the parking, then the employer may be able to mitigate the exposure to unrelated business income for the cost of the employer-provided parking. It is important to go back and reiterate that if the hospital is going to charge for parking, it must be a fair market value charge. It would not hold merit to simply charge each employee a small figure, such as $5 a year, for the benefit of parking on site. Those items that we previously talked about are ongoing benefits to employees frequently offered to both physicians and non-physician employees. However, hospitals sometimes offer additional items on an infrequent basis that we would call perks. Some of these perks are going to be taxable, some of them will not be taxable to the employee. First and foremost, gift cards are always going to be taxable to the employee. It does not matter how small or large the value of the gift card is. It does not matter if the gift card is to a store or restaurant the employee is not interested in utilizing. If an employer provides gift cards to an employee, it is always taxable to the employee. Sometimes hospitals provide employees with a voucher, and the voucher can be used to trade in for merchandise that the hospital has logoed with its own logo. In this case, that type of voucher is not available for public use. An outside person that's not an employee would not be able to receive value from the voucher and come into the employee store and choose the logoed item. And the provision where hospitals provide logo items to employees, those are not going to be taxable to the employee. And if we think about this, it makes sense. It's in the hospital's interest to advertise. And one way to do that is to provide logo items that your employees will wear or utilize out in the community, such as a t-shirt or a coffee mug or a water bottle. In addition, it's in the hospital's interest to boost employee morale and make them feel like they are part of a team. And one way to do that is with insignia such as the hospital's logo. Therefore, providing logoed items to your employees is just as much a benefit to the hospital as it is to the employee. Those items, when provided to the employee, are not taxable income. Certain hospitals, either on their own or have set up an entity to provide assistance to employees. This is oftentimes in the form of cash, but it may be in the form of non-cash. It can be as the result of a disaster, or it could just be as a result of an extreme economic need on behalf of the employee. Under these types of programs, the employee will provide substantiation for his or her need to a committee, and the committee will make a determination whether there is a need and how much cash or non-cash assistance to provide to that employee. These programs cannot discriminate against any particular class of employees. The exact language is that they must be available to a broad section of employees, which could be determined to be only full-time employees and not include part-time employees. That would be a broad class of employees, but it cannot discriminate for only physicians or only people that live in this geographic area. It needs to be broadly available to the largest group of employees possible. In order for the assistance to not be included in the employee's taxable income, the employee must provide proof of extreme need, and the need must be to support life, meaning a mortgage payment or other costs to provide shelter, food, housing, clothing, and or transportation to or from work or medical facility. Alternatively, the need could result from a nationally declared disaster. The employee provides substantiation of the need, and then the committee makes the determination whether the employee will be provided assistance. The committee must be independent. Independent means that at least half or more than half of the committee is made up of individuals that are not the decision makers or have a financial interest in the hospital. In other words, the committee could include the CEO and the CFO of the hospital, but it needs to have a majority of the members be independent from the financial needs, overall financial needs. That does not preclude them from being employees of the hospital, but they should not all be the highest level executives. If all of those qualifications are met, then the assistance is not taxable to the employee, even if it is cash. From time to time, employers provide non-cash awards to certain employees. To the extent that those awards, non-cash awards, are provided for length of service or for safety achievement, those non-cash awards are not includable in the employee's taxable income. However, cash awards for any reason are going to be taxable to the employee. Even if the cash award is for length of service or for safety, it's still includable in the employee's taxable income. Over and above that, an employer may provide non-cash gifts to employees of a nominal value and have those gifts not be included in the taxable income of the employee. The question arises, of course, what is nominal value? And the IRS has not given a clear, bright line standard for that. However, the IRS has issued one private letter ruling whereby the employer provided a non-cash gift to an employee with a value of $100. And the IRS said that that was not nominal value. Therefore, most practitioners interpret that a gift with a value of $75 or less can be excluded from the taxable income of the employee. Again, only if that gift is non-cash. A cash award or gift is always going to be taxable to the employee. Next, let us talk about supplemental wages. This is probably everyone's favorite kind of wage because it is typically a bonus. There are other types of supplemental wages, such as commissions, but probably the most common that we will see in a physician's compensation package is a bonus. The question here is not whether or not those supplemental wages are taxable, because they are taxable every time. However, the question here is, what methods may the employer use to withhold federal income taxes from the supplemental wages? There are two acceptable methods. The first is to take the aggregate of the supplemental wages plus the regular wages and apply the standard income tax withholding tables to the sum of those two numbers. Let me give you an example. If my base wages are $1,000 and my bonus is $500, the employer can take the aggregate, or $1,500, and apply the standard income tax withholding table rates to the $1,500 and withhold accordingly. Alternatively, the employer may report the supplemental wages separately and withhold on the supplemental wages at a flat rate of 21%. So back to my example. If my base wages are $1,000, then the employer would use the standard income tax withholding tables to withhold on the $1,000 of regular wages. The employer would also withhold a flat 21% on the bonus payment of $500. This does not preclude the employer from paying the payment all at one time or through the regular payroll cycle. It simply is an allocation of taxes withheld from the two different types of wages. It is important to note that an employer may not withhold 0% on supplemental wages based on the employee's request, unless that employee can prove that he or she is exempt from all income tax, either in the previous year or by certifying that they will be exempt in the current year. The employee should have already filled out a W-4 to indicate that he or she is completely exempt from all federal income tax on all wages, because either he or she did not pay any income tax in the previous year, or he or she reasonably expects that they will have zero income tax liability in the current year. The employee would sign that statement to verify that, and in that situation, the employer would withhold 0% on all wages, regular and supplemental. However, it is not acceptable for an employee who otherwise has taxes withheld from regular wages to request that 0% be withheld from supplemental wages, such as a bonus. Sometimes the physician may indicate to the hospital that he or she does not believe that they will owe additional tax based on their personal situation. However, again, that is not an acceptable method for the hospital to take the word and only withhold it at 0%. And now we have our third polling question.
Thank you. The third polling question is, gift cards are always taxable when provided to employees. Please select one, true or false. Remember, you must fill out the polling questions in order to receive CPE credit. You will have 45 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Emily.
Thank you. It is my hope that polling question number 3 was very simple and that everyone answered true, because yes, gift cards are always taxable to the employee. Next, let's discuss the difference between an employee and an independent contractor and how that affects a potential tax liability. It is sometimes a gray area to determine if a person that's providing service to your business is an employee or is that person an independent contractor. The IRS has a three-pronged test to help guide the determination of whether that person is providing service as an employee or an independent contractor. The first prong of that test is behavioral control. Does the business have the right to control how that worker is going to do that job? If so, then that lends itself to the possibility that that person, that worker, is an employee. This does not mean that a physician is not able to exercise their professional judgment when administering care. Of course, the physician is going to use his education, his experience, and his professional judgment to examine, diagnose, and determine a treatment for any specific patient. That does not mean that in and of itself that that physician is an independent contractor, because the physician is making the determination of how to treat and handle this patient. If the hospital has the ability and the right to direct the hours and shifts that that physician is going to work, the days of the week, perhaps even the types of patients that physicians will see broadly, then the hospital really does have behavioral control over the physician, and that lends weight to this physician most likely being an employee of the hospital. The second prong is financial control. This does not refer to who is paying who, because either way, the hospital would be paying the worker, whether the worker is an employee or an independent contractor. Instead, this means who has the financial investment in the supplies, tools, and facilities that are needed for that worker to be able to perform service. If the hospital is paying for the medical supplies, the medical equipment, the medical facilities, then that lends more weight to the relationship being employer and employee than if the physician was providing those items, the tools and supplies, in his own right. Now, that one could clearly be a gray area, which is why we have a three-pronged test. The third prong is the type of relationship. Does the relationship look similar to the relationship that the hospital has with other employees? Meaning, does the hospital provide benefits to this individual, such as health insurance, vacation pay, holiday pay, etc.? If so, all of those are benefits that the hospital also provides to employees. And therefore, the argument is that this person is providing services to the hospital as an employee. All three of these will help guide you to a determination. But as I said, it can be a gray area. Oftentimes, there are situations where part of the duties that a physician provides are clearly of an employee type relationship, whereas some of the other types of duties that the physician provides are more of an independent contractor situation. Well, the general rule of that is once an employee, always an employee, at least until something big changes. If we have a physician on staff that is an employee, clearly, because the physician provides services similar to an employee, the hospital can direct or control the behavior. The hospital provides the tools, supplies, and facilities, and the hospital provides working condition benefits and other types of employee benefits, such as health insurance. Then to the extent that the hospital is providing remuneration to that physician, it is going to be as an employee and reportable on the W-2. It may be that the physician is going to add additional duties, such as duties as a medical director. And sometimes those duties, if performed by an outside person, would be considered to be performed by an independent contractor, and therefore paid and reported via the Form 1099, which is the form that the hospital would remit to an independent contractor. Well, if our employed physician takes up those additional duties, that does not change the fact that the physician is an employee. And even if those duties would otherwise have been reported on a 1099 to an outside person, they're still going to be reported for this physician as W-2 wages, because back to the mantra, once an employee, always an employee. If the employee ceases providing services as an employee, turns in his resignation, walks away, becomes employed by another facility, but still continues to provide services as an independent contractor, as the medical director, at that time, the determination of that individual status could change to independent contractor, and the income could be reported on Form 1099, but only because there's been a substantial change in situation. Once we determine that an individual is an employee versus an independent contractor, why does that really matter at the end of the day? Well, it matters because it depends on who is going to be liable for certain portions of the tax. An employer is required to pay a portion of the payroll taxes on behalf of employees. It's something similar to half, depending on each employee's situation. In this case, the employee is going to be responsible for paying and paying half of his payroll tax liability, and the employer is responsible for paying the other half or portion allocated. However, for an independent contractor, the business is not required to pay any payroll taxes on behalf of the independent contractor. The independent contractor is responsible for paying all of the payroll taxes that he or she is liable for. Now, this sounds like a situation that's not very desirable for the independent contractor, but we should note that an independent contractor is allowed to deduct business expenses against their income, thereby potentially reducing their overall tax liability. An employee is not allowed to deduct business expenses, at least not directly against the wages that he or she earns via employment. Unfortunately, errors do sometimes occur, and sometimes there's a duplicate payment made to an employee. This could result from, a system error, or we're changing a payroll system, or changing the payroll provider. Whatever the cause, it happens. And the question is, how do we fix this? Well, if the employer uncovers the overpayment within the same calendar year, then the employer may recoup those duplicate wages from future pay periods subject to state law. Some states require notification, some states only allow a certain time period. You would need to consider your own state. However, the employer, to the extent allowed by state law, would be able to simply reduce future paychecks until the overpayment is corrected and made whole, and the hospital is made whole. Alternatively, the employer could request that the employee simply repay the wages, write a check back to the hospital. If this is the case and the employee pays the hospital back, then the hospital would need to go back and amend the prior payroll tax returns that had reported the additional or the duplicate payment, because there would be duplicate payroll taxes remitted. If this is rectified within the same calendar year, then the duplicate wages will not be reported in the employee's current W-2, because the employee did return the duplicate wages back to the hospital, and therefore they would not be taxable wages, would not be reported in the W-2 for that year. Where it gets a little mishy-mashy is if the duplicate payment is not uncovered in the same calendar year. If the hospital doesn't determine prior to the calendar year end that the overpayment occurred and discovers it in February or some other month in the following year, then the hospital needs to or should request that the employee pay back the duplicate payment. However, that's not going to change the payroll tax returns that were prepared and filed in that year of the overpayment, the duplicate payment. The payroll tax returns that were filed in the year in which the duplicate payment occurred were correct as of when they were filed, and the W-2 would be issued and show that the duplicate payment was in there because that was correct as of the end of the calendar year. The employee then remits payment back to the hospital in the following calendar year, and unfortunately, the employee is not going to be able to reduce his or her current wages in this year directly by that payment because of it will not be reflected in the W-2. Now, it is possible that there could be another deduction elsewhere on the tax return, and that employee would need to look at his or her individual situation to make that determination. In a situation where the employee refuses to pay back the duplicate payment, the hospital may have recourse to sue or terminate the employee, or maybe even both. But if the hospital chooses to overlook it and allow the employee to essentially keep the duplicate payment, before the hospital comes to that final conclusion, it needs to consider how that affects overall compensation and reasonableness of compensation, and specifically the Stark law that means that requires that the physician compensation must be a fair market value. And if we knowingly allowed that duplicate payment to remain unpaid back to us, we just need to consider that. It's not a one-size-fits-all, of course, but you cannot just look at the duplicate payment in a vacuum. You do need to look at it in regards to regulatory bodies that are overseeing physician compensation. So in conclusion, of course, physician compensation packages are very creative. It's not at all the norm anymore to just see a base salary and maybe a bonus. Physicians want to take advantage of other perks, opportunities, and benefits that the hospital can provide. And that's great because there's a common goal. The common goal is the hospital wants the physician to accept employment and the physician wants to be employed. However, the physician wants to get paid, of course. It is important to consider before finalizing these contracts, not only is the total compensation reasonable, but which of these perks, benefits, and other types of remuneration are going to be taxable to this employee, because we don't want any surprises once it comes time for the employee to file his or her tax return. And lastly, I want to leave you with this. Regardless of the wording or language in the contract, the contract language cannot override tax law or the Internal Revenue Code. Just because a contract states that some specific item in the compensation package is not taxable to the employee does not negate the fact that it may be under the Internal Revenue Code. So it's important that all parties do their due diligence to understand the tax impact of each of these items in the compensation package before it is finalized. And with that, we have just 1 minute left. If you have any questions, please send them in. I'll be happy to respond to them directly.
Thanks to our presenter, Emily Smithson. If you have questions, her presentation and contact information will be emailed to you, along with a recording of today's webinar. Also, if PYA can provide assistance with tax, audit, compliance, valuation, or physician services, call or email us. You may also visit our website at pyapc.com for more information about our specific areas of expertise, or to subscribe to receive PYA insights. Please remember to stay on the line once the webinar disconnects to complete a short survey for CPE credit. On behalf of PYA and FHA, thank you for joining us and have a great rest of your day.